Hi, and welcome back. This is Chapter 20, Variable Costing for Management Analysis. In this chapter, we're going to be exploring concepts of variable cost and the impact of change from variable cost through a couple of different concepts. The first one is called absorption costing. When you hear the word absorption, think of a sponge. A sponge absorbs water. Okay, a sponge absorbs water. The same concept applies with respect to costing. We absorb costs. Absorb costs. Under absorption costing, the cost of goods manufactured consists of, as you know, direct materials, direct labor, factory overhead. This fixed and variable factory overhead, I should say. In the financial statements, these costs are included in the cost of goods sold on the income statement, as you know. Absorption costing, from a report perspective, we take, let's look at from this area. We have our sales, our revenue, minus our cost of goods sold equals gross profit, minus selling administrative expenses equals income from operations. Variable costs, as you know, are costs that change based off of the number of units produced or the level of output. Variable costs include direct labor, direct material, and variable factory overhead. Under variable costing, fixed factory overhead is our costs are not a part of cost of goods manufactured. Fixed factory overhead is recognized as an expense. We learned about this in the last chapter as well. In absorption costing, we absorb the cost. We absorb direct materials, direct labor, variable factory overhead, and fixed factory overhead. In variable costing, we take direct materials, direct labor, and variable factory overhead. We recognize that fixed factory overhead is an expense. That's the difference between absorption costing and variable costing. The primary difference between the two is in absorption costing, where we absorb fixed factory overhead in our total cost of goods manufactured. In variable costing, we recognize fixed factory overhead as an expense. So from a reporting perspective, in variable costing, you have your sales minus your variable cost of goods sold equals your manufacturing margin minus your variable selling and administrative expenses equals your contribution margin. Then, of course, you have your expenses. We realize that in our fixed expenses, we have fixed manufacturing costs and fixed selling and administrative expenses. Within your fixed manufacturing costs, we have, of course, our fixed factory overhead. So you take your total costs, we take our contribution margin minus our total fixed costs equals income from operations. Manufacturing margin, what is it? It's the excess of sales over variable cost of goods sold. To calculate it, we take our sales minus variable cost of goods sold. That gives us manufacturing margin. Then we have our variable cost of goods sold. This is direct materials, direct labor, and variable factory overhead for the units that are sold. Contribution margin, as you know, is the manufacturing margin minus the variable selling administrative expenses. Then, of course, we subtract out the fixed costs. Here's an example. In this example, we manufacture 15,000 units, sold at a price of $50 per unit. our variable costs, 15,000 units. Variable cost is $25 per unit. Fixed cost is $10 per unit. Brings us up to $35 total cost. But here's the thing. We have another set of variable costs, right? Because we have variable manufacturing costs, but we also have variable selling and administrative expense costs. This is where it gets a little tricky. We're breaking out the expense. We're separating them into manufacturing costs and selling administrative. We're separating variable and fixed, okay? In this example, where our variable selling administrative expenses are $5 per unit. Under absorption costing, as you know, absorption costing, we're absorbing both the fixed and variable expenses together through direct materials, direct labor, and fixed and variable factory overhead. So through absorption costing, we have our sales minus cost of goods sold equals gross profit minus selling and administrative expenses equals income from operations. It's condensed. It's absorbed. It's absorbed. Okay, it's condensed. And the way you can tell is when you look at selling administrative expenses, we have both fixed and variable selling and administrative expenses together. That's absorption costing. Under variable costing, this is where we separate out fixed and variable based off of the activity, based off of manufacturing and based off of selling and administrative. Sales minus variable cost of goods sold equals manufacturing margin minus variable selling and administrative expenses equals contribution margin minus all of our fixed costs equals income from operations. When the number of units manufactured equals the number of units sold, income from operations will be the same under both of these methods. It's kind of like break even, but it's break even from the perspective of the two methods of cost. Your variable cost method versus your absorption cost method. When units manufactured exceeds the units sold, the variable cost of income will be less than the absorption cost. In our example, let's assume that 12,000 units out of the 15,000 units manufactured were actually sold. So in other words, I only sold 12,000, but I made 15. Okay, so that's a difference of 3. So I sold 12,000 at $50 per unit, 600,000 in revenue minus variable costs. I still made 15, so I still have to account for my variable costs at 15. So that's why you see this difference here. Variable cost 15,000 times $25 per unit, $375, minus the ending inventory. Ending inventory, remember, I only sold 12. I made 15. So that's 3,000 units times the 25. 375 minus the 75 is 300. 600 minus 300 is 300. 300 is my manufacturing margin minus variable selling administrative expenses of 60,000. Now here's the thing. The variable selling administrative expenses is 12,000 units. The reason why it's 12,000 units is because I sold 12,000 units, right? So manufacturing margin minus variable selling administrative expenses equals 240. Fixed costs, I have fixed manufacturing cost 150, fixed selling administrative of 50, that's 200. 240 minus 200 is 40. And then, so that's under variable costing. Under absorption costing, it looks like this. Sales 600. Cost of goods manufactured 15 times the $35. Why 35? Because why? I don't know. Oh, that's because the 25 plus the 10, right? So 35, 525 minus ending inventory, 3,000 times the 35, that's 105. 525 minus 105 is 420. 600,000 minus the 420 is 180 for gross profit, minus selling administrative expenses, number of units sold times the $5 selling administrative expenses variable plus the fixed of 50,000. That's 110. 180 minus 110 is 70,000 from income from operations. So as you know, there's a difference between the two. 40,000 is different from 70,000. This difference in the statement also will have a difference on the impact of the company from a tax perspective. So the $30,000 difference between the two is due to the fixed manufacturing costs. Because under the fixed manufacturing costs and variable, we only recognize the fixed manufacturing overhead and the fixed selling administrative. However, in the absorption, we recognize both together. So because of that, it creates this difference, right? And of course, the ending balance of inventory is treated differently under the two. So what happens when units manufactured are less than units sold? The variable costing income from operations will be greater than the absorption cost. So it's kind of like the opposite, right? Beginning inventory balance of 50,000. So here's an example. We have beginning inventory of 5,000 units. We manufactured an additional 10,000 units during the period, and we sold 15,000 units during the period at $50 per unit. So here's the cost structure. Beginning inventory, 5,000 units. So basically what you need to do here is you break it out by beginning and current inventory levels. So it's similar to what we learned about when we talked about inventory, first in, first out, last in, first out average. The same concept that kind of applies here. The difference here is that the difference is going to be based off of the total number of units sold. So you have your variable and fixed, your variable and fixed. If we notice that the fixed is higher the current period because we produced an additional 10,000 units, right? We have a difference of $5. The difference came from an additional $5 per unit in fixed costs under the absorption costing method. Then we have the selling administrative expenses. $5 went to variable because, as you know, we separate them out based off of the variable costing method. $5 times the 15,000 units sold equals 75,000 variable cost. The fixed costs were 50,000, giving us a total cost of 125. And of course, here's how it looks from an income statement perspective under both absorption and variable. We can see the primary difference here in our income from operations under absorption is 50,000 but under variable, it's 100,000. So the difference came from the allocation of variable cost. Under absorption, we absorb it in the manufacturing process. Under variable, it's broken out. So every time we break out that additional cost, and it's not attributed for in the manufacturing process, we have a difference when it comes to our expenses. So the $50,000 difference is income from operations due to the fixed manufacturing costs. Beginning inventory, absorption cost, and the 50,000 came from 5,000 units times $10 of fixed manufacturing costs incurred by the period. So what you need to know is if the units manufactured equals the number of units sold, then the absorption cost will be the same as the variable cost method. If the number of units manufactured is greater than the units sold, then absorption cost will be greater than variable cost. If the number of units manufactured is less than the number of units sold, then we know the absorption cost will be less than the variable cost. So what do we do with all this information? Well, we compare it, of course. When the units manufactured are greater than the number of units sold, finished goods inventory increases, as you know. Under absorption costing, a portion of this increase is related to the allocation of fixed manufacturing overhead to the ending inventory. And of course, as a result, the inventory levels will rise. So here's another example. Example's not that great, but we'll go through it. We estimate this company's beginning inventory and sales are estimated to be 20,000 units, $75 per unit. We assume that sales will not change more than 20,000 units manufactured. The company is evaluating whether to manufacture 20,000 units or 25,000 units. Costs and expenses related proposals are here. So proposal 1. We manufacture 20,000 units to be manufactured and sold. Okay? So our variable cost, $35 per unit. Our fixed costs are $20 per unit with an allocation of $5 per unit to variable selling administrative expense. We got $20 per unit fixed by taking our total fixed cost divided by the number of units produced. Total cost divided by the number of units to be produced equals our total fixed cost per unit. 35 plus 20 is 55, so $55 total cost per unit. Our selling and administrative expenses, variable costs 100,000, fixed costs 100,000, that's 200,000. Our variable selling administrative expenses, we figured were 100,000 because we took the total number of units to be sold times $5 per unit. Under proposal 2, this is selling 25,000 units. We do the same exact process. But here's the difference. The fixed cost per unit, as we know, is less. But we're producing more. How can that be? Well, the reason why it's less is because we have the same fixed cost divided by a higher number of units produced. This goes back to our earlier example of perfume in the last chapter. The more I produce, the lower the total cost per unit is, right? And the way that that happens is that the total fixed cost per unit decreases when I produce more units. So 400,000 divided by 25,000 equals 16. And that's where the biggest difference comes in, right? We can see that our total manufacturing costs, of course, are going to be higher. We get that because our total variable costs are higher. So looking at the two proposals side by side, 1.5 million in sales projected because we're going to sell for $75 a unit. Cost of goods manufactured, $55 per unit, $51 per unit. Ending inventory, gives us total cost of goods sold, $1,020,000 versus 1.1 million. Gross profit is a little bit higher than proposal 2. So the short answer here is proposal 2 looks like the better of the two proposals because my income from operations will be $80,000 higher. That's basically what that slide says. The $80,000 increase from proposal 2 is caused by the allocation of fixed manufacturing costs of $400,000 over a greater number of units manufactured. So again, the more units we manufacture, the lower our total fixed cost per unit will be. And when that happens, we typically see a lower total cost per unit. That's just what all that summarizes, right? So using absorption and variable costs together helps us to make better decisions. Basically, it helps us to better control our costs. It helps us to price our products more efficiently, plan for production, analyze contribution margins, and helps us to analyze the market segment. So by looking at absorption and variable costs, we look at our reports, management's able to make better decisions, and our decisions help us to better control costs, help us to better price our products, plan for production, analyze contribution margin, and to analyze the market segments. All those are good things because it helps the business to be more efficient. Controlling costs, when we control costs, we talk about all costs of the business. This will include things like plant supervisors' salaries. This would, although there might not be control over things like insurance related to the property, plant, and equipment, we'll have control over costs that we can have control. We call these controllable costs. Controllable costs are costs that can be controlled by management at certain levels. We cannot control certain costs. We call these non-controllable costs. These would be things that are well outside of management's realm. It would be things like insurance premiums. Can't control that. I can't control that the insurance keeps going up, okay? I can't control that. I can't control certain other factors. I can't control environmental factors. Variable manufacturing costs can be controlled by operations and management, in contrast with fixed costs. Fixed costs such as salaries, supervisor salaries, those can be controlled at higher levels of management. Since fixed costs and expenses are reported separately under variable costing, variable cost reports are normally more useful than absorption costing reports and controlling costs. Pricing our products. We can best price our products by looking at absorption and variable costing because we can make better pricing decisions. In the short run, fixed costs cannot be avoided, so we need to make sure that our fixed costs are covered in our product cost. In addition, we need to be able to also price for our variable costs to ensure that we're breaking even at minimum, or in better cases, earning a profit. So since absorption costing includes fixed and variable costs in the cost manufacturing of a product, absorption costing is oftentimes more useful than variable costing in a long term perspective. We look at absorption costs and variable costs to plan for production. In most cases, operating decisions must be made quickly before opportunity costs are lost. So, for example, in a seasonal business, we need to make shifts in our production schedule. So, therefore, short-run decisions are more can be better planned for, right? That's kind of what this slide tells us. And in long run, planning production can include expanding existing capacity. And so in the long run, typically absorption costing is best. In the short run, variable costing is best. And of course, analyzing contribution margins, oftentimes we compare plan versus actual contribution margins. Variable costing is often used for this basis. What about market segment? Market segment is a portion of the company that can be analyzed using sales, costs, and expenses to determine profitability. Examples of market segments include territories, products, salespeople, and customers. Absorption costing is most used in the long term, and short term is usually variable costing. Most companies prepare variable costing reports for each product. And here's an example of that. In this particular example, the company breaks out their market segments by northern and southern divisions, and they look at their sales and variable costs for a couple of different products. Here's two products and two different divisions. We can see the overall breakdown of variable costs and fixed costs. That helps us to give an idea of the overall profitability of each product within each market. Sales territory profitability analysis is where we break down by looking at the different territories to reduce costs in lower profit territories and increase sales in higher profit territories. So the Northern Territory, Southern Territory, looking at our sales, the more that we can control our variable costs and increase our overall sales price, the overall better those products will do in those markets. Again, looking at the contribution margin ratio, as you know, you take your contribution margin divided by sales to get your contribution margin ratio, and you can do that for each product within each territory. Product profitability analysis, companies should always focus on profits, and to do that, we look at our products that we sell to understand their profitability. And you can perform profitability analysis by looking at the contribution margin ratio for each product within each territory. You can also look at it from a salesperson perspective, how efficient each salesperson is doing by looking at their total sale, by breaking it out by salesperson within each territory. And all of these are really good to help the business be more profitable. Contribution margin analysis focuses on explaining the differences between planned and actual contribution margins, looking at sales and variable costs, number of units sold, and the sales price or cost per unit. Quantity factor. Looking at the quantity effect on the difference of the number of units sold, assuming no change in sales price or cost. To figure out sales quantity factor, we take the actual units sold minus the planned units of sales times planned sales price. You also figure out the variable cost quantity factor by taking the planned units sold minus the actual sold times the planned unit price, or planned unit cost. It's also what we call a unit price factor. Unit price factor, or also known as unit cost factor, in effect is the difference in sales price per unit sold. To figure this out, we take actual selling price per unit minus the plans times the actual. And it's the cost is planned minus the actual times the actual. And of course, looking at the contribution margin, take your actual minus your planned. I think we're almost there. Let's see, reporting income. I'm just kind of breezing through some of this because it's really not as important. Contribution margin report for service companies can be used to analyze and evaluate market segments. Nice to know, right? And we're there, yay. Okay, we made it through the end of chapter 20. Are there any comments, questions, concerns from Lakeisha or Samaya that I could help to answer at this time?
No, I started on 20. I actually almost got 100. There was only one problem that I was trying to figure out, and I think I know how to do it. So I already finished 20. I just have to go on there and do get that one last answer and submit it, and I'm done. I got 100%. So
Awesome.
I'm good.
Perfect. Happy to hear. Wonderful. Thank you so much. Samaya, are you okay?
Yeah, and my issue is retaining all of these formulas in my head. I'm trying to find a way to keep them, because I'm used to the computer inputting everything for me. So
right. Yeah, so Samaya, what I recommend that you do is work through the example exercises in the book. Even if you do it by hand using the formulas, that's the best way you're going to remember the formula is by actually running it through examples.
Yeah, that's what I've been doing. Because on the back of the book, they give you some options to really do some hands-on with the formulas.
Exactly.
Other than that, the key terms and everything, I got the language.
Good.
It's just getting the formulas.
Yep.
And remembering which numbers to use based off of how the word problem is formatted.
Exactly. Yep. But once you get down those formulas and what the terms are, you'll have it.
Right.
Very confident. So great. Good to hear. Sounds like you got a good plan. Okay. Any other comments, questions, or concerns before we call this a meeting? It's just the two of you here. So.
No, I think I'm good.
So it's just the two of us here?
I didn't even notice everybody had signed off.
Wow.
Everybody else dropped off. Well, we did run a little later than normal today, and I know that some students also have another class that started at 1.
Oh, okay. Yeah, I mean, I'm fine. I'm good. I've been doing good, really, Professor. Like doing everything you said do. And like what you're saying, like study. With the studying and basically like me, I'm a visual. For some reason, I'm a visual learner. So when I see something, I remember how to do it. Once I do it once, I know how to do it. I don't have to. For some reason, I can look at something and remember how to do things in my head, and that's what actually was helping me on the homework, on chapter 20's homework.
Awesome.
I was actually like remembering what I had read and what I had did and what it was asking me for, and that's what I needed to remember because I have a problem with word problems. I have a hard time in understanding what the word problem is asking. So that's why I had to like figure out a way to where I can understand and pick this accounting up for me better. You know what I'm saying? So the way that you had said does work out very great because I've been using that. And as you can see, I've been doing good on my assignment. Right. So I'm learning something.
Exactly. And then, like you said, if you extract the key components from that word problem and you plug it into that formula, you'll be fine. It's just a matter of knowing what to pull out. Exactly. Yeah.
Now, I will say this side of accounting is way easier for me personally because I have actual experience on the managerial part of accounting.
Right.
So this kind of helps me and allows me to put what I know into my studies. But now it's like now I'm learning. Like if the computer fails, I will still be able to do my job because
Yes,
now I know the formulas and how to make sure that everything is inputted correctly.
Awesome. I'm so happy to hear that. Yeah, I agree with you. I think managerial accounting is a lot more applicable and a lot more usable than financial accounting is. I mean, financial accounting is what we learned how to put it together, but now we're learning how to interpret it, and which I think is much more important. So cool. Fantastic. Okay, well, in that case, I hope you both enjoy the rest of your day. Stay safe, wash your hands, all that great stuff. And I am looking forward to seeing you both again next week around the same time.
I'm about to get ready for an interview, Professor.
Okay, well, hey, best of luck with that then. That's fantastic.
Yeah,
So
thank
happy
you.
to
With
hear that.
Catholic Charities, you heard of Catholic Charities, right? With Catholic Charities in the District of Columbia. I'm gonna be a what is it, a patient, what is it, what they call it, a program associate.
Oh,
So I'll
got
be
you.
working with the homeless of the District of Columbia. So I'll be working out of the hotel. You know, they put the homeless people in the hotels in the district throughout the District of Columbia. So I'm going to be working out one of the hotels on New York Avenue. So I got my interview today at
Wonderful.
3:15. So I'm about to get ready for that.
Well,
So I just want to let you know all the good things that's happening.
I'm
You
so
have a
happy to hear that.
wonderful weekend, and I'll definitely let you know how it goes.
Yeah, please do. And if you need me for a reference, feel free to put me down. Okay.
Oh, I sure will. I sure will. Thank you so much, Professor, for that. Thank you. I appreciate that.
My pleasure. Awesome.
Okay, you have a blessed weekend, sir.
Thanks. You too. Take care.
Okay, thank you.
All right. Bye-bye.
Bye-bye.